In this session, we're going to have a look at one of the new syllabus areas that's coming into F3, and that is interpretation of the financial statements. Now, it's all well and good being able to prepare a set of financial statements, but can you read them and interpret a company's financial performance and also their financial position, the health of their business from those financial statements? Can you compare their results with other companies, or maybe with the prior year results, and analyse and see if the profitability, performance, position has improved or declined, as with the comparative? Now, one of the problems with just looking at the financial statements is that all the numbers are given in absolute terms. Maybe they don't mean an awful lot. Maybe you need to quantify those absolute numbers given in the financial statements by way of some ratio analysis. So what we need to be able to do in this chapter is to be able to calculate performance and position ratios, but also to be able to analyse and interpret the performance and position and see, whether it's improved in the period or whether it's declined, but also giving possible reasons why. This really does summarise everything that we've done and the impact on our estimates, the policies that we've chosen, and how we prepare our financial statements. We're going to use all of that information in this chapter to help us analyse performance and position. So, in this session then, we're going to have a look at our first set of ratios, and they will all be based on financial performance. Now, the first thing we're going to have a look at is the profitability ratios. And all the ratios that we're going to look at over the coming sessions need to be learnt. So, we must learn all of these ratios that I'm going to tell you in the forthcoming sessions, and we need to be able to apply them to exam scenarios. So, thinking about the financial performance of an entity, we're really focusing on the profitability of a particular company. Now, the first thing we can do is have a look at a gross profit margin. So, gross profit margin. What percentage of our sales revenue drops down into gross profit? So, very similar, if you remember, to what we saw in incomplete records when we looked at profit margins. But we're going to use them to analyse how profitable a business has been in the period. Now, you'll be given all the information in a question. All you have to do is quantify it as a percentage. So what we do then is we take the gross profit and divide it by the sales revenue of the entity for the period. Both of those figures come from the income statement or statement of comprehensive income. Now, if we take the gross profit and divide it by sales, we then multiply it by 100 to give a percentage. Okay, so what profit margins do we make from our sales? How much of our sales revenue drops down into gross profit? Okay, remember that's your trading profit. Now, what we also have to do is we have to analyse why that profit percentage has increased or reduced in the period, either compared to last year, to an industry average, or to another company very similar to ours. So why would the profit margin, let's say, increase? Well, there's various reasons for that. Maybe you are selling goods at a higher profit margin. Okay, so your selling price for the goods has increased over the period as compared to last year. So, an increase or reduction in selling price could be a possible reason why your gross profit margin has increased or reduced. You're selling the goods for a greater price per unit or a lower price per unit. Other possible reasons could be volume. So maybe you're selling your goods and you're selling more in volume, so you're selling a higher quantity, but because of that, maybe you have had to lower the price. And as such, your sales revenue may have gone up, but what drops down into profit as a margin may well be lower because you've sold them at a lower price. Maybe you've offered more trade or bulk discounts. Bulk discounts, especially if you're selling large quantities. So changes in sales volume could also have an impact on your gross profit margin. Now that's thinking about sales, but what about cost of sales? Now remember, sales less cost of sales would equal gross profit. So what sort of changes in cost of sales could explain a change in gross profit margin? Well, it could be lots of things. Chances are that cost of sales would go up in a similar proportion to your sales revenue. And that's because the more you sell, the more cost of sales you have if you have a lot of variable costs. Now, fair enough, variable costs change in direct proportion to the number of units you produce and ultimately sell. There could be other reasons. Maybe you're absorbing more overhead. So if you are doing F2 at the minute, it's quite handy to bring that in if you like. Maybe you're absorbing some more fixed overhead and thus your profit margins are going down. But other reasons could be, well, maybe you've got higher import duties. So your carriage inwards, your delivery costs have increased and as such are reducing your profit margins down. Other reasons could be large inventory write-offs. Okay, so maybe your inventory has become obsolete and you need to write it off because you cannot sell it anymore. All of those would be valid reasons why the gross profit margin would have improved or declined in the period. So really what we're focusing on is changes in sales and cost of sales. Our next profitability ratio we need to look at is the operating profit margin. Now the operating profit margin takes your operating profit and divides it by sales. We times it by 100 to give us a percentage. Now, operating profit is your profit before interest and tax. So your profit before interest and tax would be your operating profit. And what we're trying to do here is express our operating profit as a percentage of sales. So how much of our sales revenue drops down into operating profit? Now, of course, there would still be various items that you need to consider, changes in sales and cost of sales. But that's what you've got the gross profit margin for. If you know that gross profit margin has increased from 10% to 20%, well, that can be explained purely by sales or cost of sales. What we're trying to look at in our operating profit margin is what lies between gross profit and operating profit. So what new do I hope to learn from calculating operating profit margin? Well, this would be a change in your other income and your other expenses. So we'd be looking at your administrative expenses, your distribution costs, and also changes in your other income. So really what we'd be looking at there is cost control. Has our expenses gone up or gone down? Is there a lot of fixed costs in there? Has there been changes in those fixed costs? And from that we can identify the entity's abilities to control their costs. But also taking it back to financial accounting, is there any changes in depreciation? If you buy more non-current assets, or even if you revalue them, if the value of your non-current assets go up, so does your depreciation charge, and as such would reduce operating profits. So are there changes in non-current assets that would impact your depreciation expense and thus reduce your operating profit? Maybe there's been a disposal, and the profit or loss on disposal has been included in the current year's operating profit, but it wasn't there last year. Maybe there's some bad debt write-offs. All of these one-off items that maybe you didn't see last year would have an impact on your admin expenses, distribution costs, or other income. So we'd be looking at changes in depreciation because of maybe a new purchase of non-current assets or even a revaluation, but also any one-off items that could explain the change in that profit margin. So like I say, a profit or loss on disposal, irrecoverable debt write-offs would all contribute to a change in operating profit margin, along with all your other expenses and other income as well. So really, to talk about sales and cost of sales again here would be inappropriate. You've already discussed those issues when calculating gross profit. We need to think about what lies between gross and operating profit, and that would be your other expenses and your other income. And you would need to be able to explain the operating profit margin change because of a change of those other expenses and other income. Our final profit margin that we're going to have a look at then is the net profit margin. Okay. Now we're going to take net profit after tax, but you could also calculate net profit before tax. Net profit is your profit for the year. It's the bottom line profit. So your income less all your expenses is going to give you that net profit at the bottom. And again, we express that as a percentage of sales. So net profit divided by sales times 100, again, is going to give you your net profit as a percentage of your sales revenue in the year. Now, again, we've explained a lot of the reasons for the change in profit margins by looking at gross and operating profits. So what lies between operating and net profit? Interest and tax. Okay, so we've already analysed most of the income and expenses and the changes in them. Now we've got to focus on interest and tax. Maybe your net profit margin was 4% last year, and this year it's only 2%. Why is that? Well, of course, that's going to be an increase in finance costs, your interest expense, or your tax expense, amongst others that we've already analysed. So maybe your interest expenses increased because maybe you've issued some more loan notes or took more borrowings from the bank. And if you're given a statement of financial position and a statement of comprehensive income, if you see that there's an increase in a loan, usually there'll be an increase in finance costs to go along with it. Has our increased borrowing increased our tax expense as well? Usually they'll be linked. But also on the opposite side of the coin, you could say, well, if we've paid off a lot of our long-term debt, surely our interest expense would go down and improve profit margins. With tax, again, your tax expense is estimated. But maybe our tax expense has been increased because maybe we underprovided for our tax expense in the prior year. And if you remember, if we underprovide for a tax expense, we have to add it to the current year's tax expense. Maybe our profit margins have gone up, and maybe our tax expense has gone down. And one of the reasons for that is maybe we over-provided for our tax expense in the prior year, and as such would reduce our current year's tax expense. So, our net profit margin then, really we're analysing the changes in that percentage because of interest and tax, but also everything above as well. But if you are calculating a gross, an operating and a net profit margin, you really need to be focusing on what lies between those profit headings in order to be able to analyse their performance in the year. So, we need to learn those three ratios, and they would be your profit margins. Now, the other performance indicators that we need to see are something known as asset turnover and return on capital employed. So, let's have a look at these. Asset turnover is your sales over your capital employed. Now, capital employed is your equity, or your shareholders' funds, plus long-term debt, your non-current liabilities. Now, we use the shareholders' equity, and we also use the money that we receive from issuing loan notes and taking out long-term debt to buy assets. We then use those assets to generate sales revenue. Now, what we do is we say, well, let's take our sales and divide it by the capital we've employed, the money that we've received to buy assets to generate that sales revenue. If you take sales and divide it over capital employed, that's going to give you the number of times that you use your assets to generate revenue. Okay? For every dollar of capital that we invest, how many times over does that go into sales revenue? So maybe your sales revenue is 2 times the capital employed. Well, great. For every dollar that you invest in assets, you're going to get $2 of sales revenue. Okay? So it really looks at how efficiently management utilize their assets to generate sales revenue. And remember, we get those assets from receiving cash from our equity share capital and from issuing long-term debt. So this shows how efficiently management utilize assets to generate revenue or sales revenue. Okay. So how efficiently are we using our assets to generate sales income? And that's going to be a good performance indicator. Of course, the more times that each dollar you spend generates revenue, the higher it is, well, of course, the better we are performing. The better we are at using our assets to generate sales revenue. So, of course, the number of times, the greater the number of times, the better. And that's the same with the other profit margins as well. The higher the profit percentages, the better we've performed. It's the same here. The more number of times our assets generate revenue, the better we've performed. So we're looking for increases on that year on year, not declines. Now, at the end of these sessions, we're going to have a look at an example where we put these ratios into play and put some numbers to them. So we'll have a look at these again in later sessions. For now, we need to remember that asset turnover is sales over capital employed, and it's going to give you the number of times your assets generate revenue. Okay, our final performance ratio is return on capital employed. And this is largely deemed to be one of the best indicators of performance or profitability. And it's very similar in calculation to asset turnover. But the numerator on the top won't be sales. It will now be profit before interest and tax, your operating profit. If you take your operating profit and divide it by capital employed, your equity, shareholders' funds, plus your long-term debt, and multiply that by 100, that's going to give you a percentage. Okay? So it's going to show how well a business has generated profits from long-term financing through issuing equity and also from issuing shares and long-term debt. Okay? And again, the higher the return on our investment, on our capital employed, the better we have performed. So again, it's another case of that percentage needs to be higher. The higher, the better. And we're looking for constant improvement in return on capital employed. Because, of course, if the shareholders are investing money and we use it to buy assets, those assets we use to generate income, that income drops down into profit, well, of course, who gets paid the profit? The shareholders through dividends. So this is really one of the most important indicators of performance. How well we're using our cash to generate profits and improve shareholder wealth as a result. So, we have 5 performance ratios that we must learn in this syllabus. So make sure you know those ratios, and we'll put numbers to those ratios in our example once we've had a look at some of the other ratios you need to learn.